Good afternoon, ladies and gentlemen. My name is Ryan Suter. I'm one of the senior investment managers here at Sharewise, and we're here with Paul McDonald, the CEO of IDT. Now, Paul's been nice enough to lend us some time this afternoon. We're going to run through a brief update. Paul's prepared for IDT, and then we're going to open it up to Q&A. So if anyone has any questions they'd like me to ask Paul after the update presentation, please submit them through the Q&A function in Zoom. Paul, it is all yours.
Thank you, Ryan. Just share. Look, thanks for having me on today. It's a pleasure to come and speak and give us some updates about IDT. We recently posted our third quarter results, so I'm going to go through most of the deck from that today and cover some of the key highlights. We have a disclaimer here for the. So look, a little bit about myself. I've came from Pfizer before I came to IDT. Previous roles in head of R&D Australia for Pfizer's hospital business, and then also I've run the contract manufacturing business at Pfizer Melbourne. So product development, mostly oncolytic injectables, but many years developing products, bringing products into facility, building robustness, process validation, CMC data for registrations, and launching commercial assets. So, the role I had at R&D Australia was looking after a portfolio of products. Had a peak annual sales of about 350 million. So I've been lucky to really cut my teeth in this side of the industry, product development of pharmaceuticals. Behind me, I've got quite a well-experienced pharmaceutical background and management team. So I have a CFO spent many years at going through the merge acquisitions at Fording to become Mayne Pharma, to become Hospira, and eventually become Pfizer in Melbourne. Vasanta's got many years of plant control behind him. Chief Operating Officer Jim Sosick, many years in operations manufacturing, also R&D and product development. He spent some time at CSL, also at Hospira, Pfizer, and the Red Cross. Priscilla has got a really good experience in not just operations, but in quality settings, and she heads our quality team, having worked in cell therapies and also CSL. She was instrumental in bringing through the AstraZeneca product into CSL during the pandemic. And Mark Flanders has joined us from Merck Sharp Dome and is a well-established commercial partner and has been part of a large driver of some of the more recent contract wins and business development that we've been able to bring to IDT. So in a snapshot, the IDT's leveraged to come into fast-growing and new markets, and the significant opportunities we see, not just fast-growing markets, but global megatrends in the pharmaceutical industry is mRNA and antibody-drug conjugate technology. These technologies are really I would say progressing at the most rapid rate compared to any other technologies that are going through clinical trial and commercialization. The mRNA really boosted out of the pandemic, and we're seeing multiple indications being addressed by mRNA concepts. And the antibody-drug conjugate is a smart therapy that targets tumor cells, specific tumor cells, binds to tumor cells and delivers a lethal dose to the tumor cells. So it's very specific, and compared to traditional chemotherapy, there's a lot less off-target side effects. So it's far more effective and doesn't have the same side effects. And then we're also seeing aging population related to cancer, but also mental health and mental illness and neurobiological disorders. We're very active in trying to grow pipelines of not just commercial products, but also in clinical phase in all three of those formats. We see the cancer and the complex formulations such as mRNA and ADC having really high barriers of entry. So we feel that as we're establishing our expertise, we want to become a go-to site for those two formats. We've got quite a strong backing in mRNA already, and we're building up our ADC pipeline every month. So as we really do establish ourselves as a leader, we're also surrounding ourselves with a high barrier to entry. They're very complex formulations, and there's also high potency involved. And these typical these type of technologies, they're very active on very, very small doses. So contamination and control of those really low doses is also quite important. We have a clear path to return to profitability. We've guided the market for our fourth quarter results, and we're announcing our third quarter results, and part of that's in this deck. But we can see that what we're actually doing is we've doubled revenue. We're projecting to double revenue in 12 months. And the pipeline that we're bringing through is going to show more uplift as we go into FY25, which we're very excited about. Now, our tangible assets is in building and land. It's currently sitting around 27 million, which is not too far off our market cap. We did a recent reevaluation of the plant and equipment for our insurance purposes in replacement value of 88.8 million. So as you can see there, our what we believe net tangible assets is puts us on strong holding to secure finance, and also it's well above our current market cap. There are 10 buildings here that cover a 12,000 meters footprint. Now, the three core pillars that we are running with, we have our active pharmaceutical ingredient. That is the traditional business that IDT has run out of. That is when you take a drug and you see the active on the label, that's what the active pharmaceutical ingredient is. And we synthesize that in various different quantities, from gram quantity all the way to multiples of kilos. Our largest reactor is 4,000 litres, which can yield somewhere around 400 or 500 kilos of active. So we have various scales. A lot of the clients come to us because they have a novel molecule. They have a new drug that they've tested at lab scale, and they want to bring that into a human clinical trial. So we will design in a GMP format, that is good manufacturing practice, a high quality version of that molecule, and we'll bring it into our facility. Now, we've picked up substantial sales in API in the last year, and what we've found is we've tried approaching our clients with an end-to-end solution. That would be, we design the synthesis of their molecule, we synthesize their molecule, and then we convert it into a finished dose, so a tablet, a capsule, a liquid oral, or a sterile injectable. So by offering that sort of end-to-end approach, especially going into a clinical trial, we've found that we've got a lot of traction and a lot of sales. The end part of that is also clinical trial labeling, placebo manufacturing, and clinical trial packaging, and release to some of the sites. So we're actually offering them a one-stop shop here in Australia, which is also very favourable with the phase 1 clinical trial being one of the fastest or the most available to get approval. You can get approval in a number of days versus many months overseas. So that's very favourable set of conditions, plus a potential R&D tax offset of 43.5 cents in a dollar. So there's quite a few tailwinds bringing those clients into IDT, looking for that one-stop shop. So specialty orals is mostly targeting neurobiological, CNS, mental health disorders. Yeah, we've got clients here with indications for oxidative stress, for traumatic brain injury, for mental health, post-traumatic stress disorder, traumatic PTSD. We also got Alzheimer's, epilepsy, migraine, sleep disorders. So a vast array of neurobiological programs that we're running through. And then, as I explained before in the previous slide, the advanced therapy is really taking those. This is our more of a future growth plan to take the very complex formulations, high barriers of entry, get in there, establish ourselves as a go-to client for bench to patient translation into clinical trial, and then eventually commercialization. Recently, we're in the press. We were able to secure some non-dilutive funding from the Victorian government to establish a pilot-scale antibody-drug conjugate facility. This will be for the stage of manufacture, being phase 1 and then potentially beyond, will be the first of its kind in Australia. We're quite excited about establishing this technology. As I said, very complex. High potency, high containment. Yes, you need to protect the product from the people from the product. You're talking about nanogram active of high potent material. So this is really exciting for us, and we're really pleased that the Allen government would back us on building this first stepping stone for our antibody drug conjugate. We do antibody drug conjugates in very small scale within our R&D lab, but this is about the next step and going into in-human pilot facility manufacturing. Just another slide to go through some of the specifics on the antibody drug conjugate facility. It is a 3.8 million spend. Most of that's not just facility, but also equipment. When you've got an antibody linker and a drug payload, you have to do binding studies, and you've got to prove how many payloads are bound to the antibody, and then also what's free, because any free unbound payload will be non-specific and be similar to your traditional chemotherapy, but once bound to the antibody, it'll be tumor targeting. So there's a lot of data that you need to collect and demonstrate through your chemistry manufacturing control, CMC sections of your data collection. They are smart drugs. They have far fewer side effects, and they target tumor, a very specific tumor cell. One of the sort of groundbreaking ADCs is really targeted HER2 BET receptor binding within breast cancer. Now there's many indications coming out. Some 10 years ago, there were 10 ADCs in the clinic. Today, there's over 100, and the number is growing exponentially. So this really is a global mega trend. It's a $13 billion market today commercially, and as the new antibodies are launched and start to take up some of the traditional indications in chemotherapy, a lot of analysts are speculating that it will reach 140 billion within, say, 10 to 15 years. So very fast growing, very active. Technology is advancing at a rapid rate, and we're really excited to be part of that journey. Another really pleasing press release we put out was a master service agreement and first contract with Sanofi. We're partnering with their mRNA Centre of Excellence. They have facilities in Brisbane, Australia, and they also have facilities in France and the US, and they're establishing a pipeline of mRNA products. So we're partnering them to help expedite their pipeline and put those into phase 1 trials, mostly in Australia to start with, and potentially to cross other regions as well. But the original focus is to work with Sanofi's research and development team to expedite some of their platform into phase 1 clinical trials in Australia. So we're really excited. The first orders are 3 to 3.5 million. there's plenty of options under a 5-year master service agreement to take up more scopes, standard statements of work to follow that and expend well beyond the $3.5 million. So we're really, some of these near-term wins we've had, non-dilutive funding, focused on the aged population, healthcare, is in neuro and cancer, building more capacity and capability at IDT, and increasing our facility utilisation. We're expanding on our license as well. We've added radio pharma licenses, and we're progressing on veterinary license as well. So we're really trying to continue to add value to the shareholders, and we see that by growing our pipeline, breaking through that profitability phase, which we're very close to, and continuing to grow and utilise more parts of the facility, and then offer new parts and new facilities as well, continue that expansion. We have a very deliberate fixed cost here on site, as I said, 12,000 square meters. So the more product flow we have going through the plant, the more that fixed cost gets spread across each of the products, the portfolios, and we're seeing a greater gross margin coming against those as a result. So I think we're really pushing hard to generate more shareholder value. I'll just touch. I've put together a TAM SAM, which I've published at 3/4. I just wanted to just sort of show a little bit of some of the potential that you could see with the ADC and the mRNA markets. We have a sterile filling facility, which is today it's underutilized. We've run a few clinical trials through it in the last 6 months, and we had it licensed just about 12 months ago to do clinical trials. So we're progressing more clinical trials through that line, but we're very focused on the complex formulation and high potencies as well. So the antibody drug conjugate and mRNAs coming through those, if they were running on that line on a 24/6 type arrangement, that would give us the potential to generate around about $805 million in revenue. So we're a fair way off that with bringing it through a client base that's going to fill up the filling line. But that's what our goals are, to get a large client base into those filling lines with complex formulations and dramatically increase the revenue generated. So 805 is extremely aspirational, but we believe we continue to build a bank of clients, push them through onto that line, high barriers to entry, complex formulation from a contract manufacturer, capacity is at a premium. So we believe that we're backing a winner on this one. The specialty oral division also available as well, and also the active pharmaceutical ingredient as well. So we see that there's substantial uplifts in both those divisions too, which are more of our core businesses. It's really the advanced therapy, which is the new one, and the one that we expect to grow the fastest. Some results from the 3rd quarter. You can see that we posted a fairly strong compared to PCP in FY23, up 48% and up 18% just on Q2 alone as well. So it's a reasonable result from where we came from. And we have a very strong sales pipeline which continues to feed. Now, with the sales pipeline, there's a couple of important things to remember. Some of these larger contracts take us sometimes 6 months to negotiate and land. There's a lot of legal content that goes through in the negotiation process. There's quality due diligence. A lot of these companies are overseas, so they'll travel to the site, conduct due diligence. So typically it takes 6 months to win a contract. Then we go into an R&D phase or a tech transfer phase. You can't win a contract and then start making the product the next day. You need to introduce it to the facility. You need to complete your risk assessments. You need to develop all the documentation, the procedures, the menus to go through and develop that product in a robust fashion to put it into a human trial or a commercialization regulatory approval. So there's 6 months to do the deal. Then there's another 6 months of technology transfer. So the work that we're doing today is generally the result of the business development that we had 12 months ago. So as you can see, we are growing. It's not substantially high, but as the business development continues to come through over the next 12 months, you'll see step changes as it comes through. As I said, the API has had the most substantial uplift. The API is represented here by the dark blue segment, and the light blue is our specialty orals, and then the very light blue, the aqua color, is our advanced therapy. You can see that's underrepresented in the bar chart, but that's the one that's coming through as a bit more of a lag vertical. Some key metrics that we put together as a comparison from, so this is year-to-date Q3. So if we compare the two, where we were at the end of Q3 in FY23 to where we are at the end of Q3 in FY24, we've had an uplift in staff from 45 to 85. Now, uplift in staff does mean higher expense, but if you go down to the third last line there, you can see that we've heavily invested in direct labour manufacturing staff that produce more and also lift the facility utilisation from 5% to 35%. We've broken past 35 now in the last quarter, but we'll continue to increase utilisation as that business development comes through. Significant uplift in revenue at the end of the third quarter, 3.9 to 8.9, and we're guiding a 4 to 4.5 Q4 finish. So again, further uplift coming through as we expect. Facility recommissions. We had some facilities that we stood down at 15% utilisation. We didn't have a less than 5% utilisation. There were facilities there that weren't being used. So we brought some of those back up. They're operational. That does take an investment, sometimes CapEx and time, but we've brought 3 facilities up. We have a 4th one that we're halfway through, and then there's a 5th one that we're looking to bring up early FY25. So we're continuing to bring more facilities online, increase utilisation, increase output, increase revenue. Pipeline at FY23 is 12 million. You can see how that correlated through to FY24, 9 million, 8.9 million at 3 quarters. So you can see that pipeline coming through. And we've got an established 26 million in pipeline at the Q3 point in FY24. So we expect a lot of that to hit FY25 and see some uplift from where we are today. So we have got a new leadership team, which I introduced at the start. We have a realigned board. The board currently been in place for around about 18 months. And the leadership's also been there for about 18 months to 2 years. So it's a fresh strategy. It's a fresh leadership team and board. We're focused on building each of the key verticals individually, but we obviously see the advanced therapy and complex formulations being a slower adopting but far heavily profitable vertical coming through over the next year or two. We successfully completed a $7 million cap raise in 23. We have another one now. The 7 million was to fund the turnaround strategy. Current 7 million capital raise that we're operating through is to fund the facility upgrades, the equipment, and the capacity increase. We are unlocking new opportunities in the mRNA, ADC, and psychedelic space, which I've spoken about, and continue to grow those verticals. We've got more predictable quarter-on-quarter revenues, and we've continued a quarter-on-quarter growth strategy, and we expect that to continue. We do expect some quarters to be lumpy and potentially not linear in growth, but overall, as a half or a financial year, we expect each half and financial year to continue growing, and we expect to continue to produce quarter-on-quarter growth, even though it may not be exactly linear from time to time. We are building a very strong pipeline back through API, progress the API into not just orals, tablets, capsules, liquids, but also sterile injectables and complex formulations. We're also very excited about being located in Melbourne, right in the middle of the medical precinct, and expanding on sovereign manufacturing within our region. We believe that mRNA is really booming in this city, and we've got enough runway to add to that expansion. And now we're adding antibody drug conjugate backed by the state government. We believe that we're adding more to the medical precinct. We know that the Peter Mac Hospital is absolutely critical to some of these new chemotherapy and targeted precision medicine initiatives, and we believe that we can provide new assets through our partners into those hospitals in the near term. We believe that we are getting to a point and the predictability that we are going to approach cash flow positive. We're getting very close in this final quarter, and we believe that as we progress into FY25, you'll see the company return cash flow positive status. As I explained just a little bit earlier, we're guiding the market to a 4 to 4.5 final quarter, which takes us around that 13 million mark, which is effectively close to double what we did in the full year in FY23. So we're quite proud to double revenue, but we know that our job's not done. We know we need to get to profitability, and we know that the pipeline of 26.6 million coming through to hit those P&Ls in the coming quarters is going to progress us toward a profitability. So again, just some very key points to finish up on. Sales pipeline of 26 million, forecasting around the 13 million. That's a growth up from 7 million the previous year. The CDMO market, what we're seeing as a general trend is large pharmaceutical companies are outsourcing more. They're reducing their internal footprints. And we see, especially around that complex formulation, that capacity with a CDMO, as a contract development and manufacturing organization, is at a very high premium. So we believe as we establish a go-to status, we'll continue to grow, particularly in those complex formulations. We got to also establishing a really solid base of return work. So some of our clients are sticking with us and coming all the way through the journey. So they might come in at preclinical, and then they'll do a phase 1, and then they'll stay with us and do a phase 2. The attrition rate of an asset's quite high going through clinical trials, but some of our customers have been very, very successful, and we're getting to a point where there's 2 or 3 of our clients are approaching and filing commercial dossiers with some of the major regulators. So our return work and our return work business has been quite successful this year, and growing a lot of that lead generation and pipeline coming through. So we're really happy with the success of our clients and the stickiness that they're willing to stay with us and see their asset all the way through to commercialization and do commercial assets with IDT. So we're not just a clinical trial CDMO, we actually have commercial assets and a growing number of commercial assets under our roof. The cash flow milestone, I've spoken about that. we really are trying to push through that in a very near term. We're getting very close, and we expect FY25 to be a very strong year. The antibody drug conjugates, mental illnesses, indications related to aging populations, naturally growing globally, but we're also jumping on those two substantial mega trends under mRNA and antibody drug conjugate. Now we're increasing our predictability, delivery, execution, building a robust balance sheet with a strong net tangible asset backing us to be able to get more financing or at least establish risk mitigation. And then I have some glossies on the pharmaceutical world. We have a lot of acronyms. So I just go through a few of them. ADC means antibody drug conjugate. API is our active pharmaceutical ingredient. Aseptic sterile processing. CDMO, contract development manufacturing organization. And I'll leave the rest of them, but those are the main ones. So that's the end of the presentation. I'm good to go back to some of the questions.
Thank you very much, Paul. Really appreciate the presentation. It was a really thorough update. So I've got a couple of questions for you just to get us going, and then we've got a couple of participant questions. Just a reminder, if anyone has a question for me to ask Paul, just submit it through the function and I'll get that one through. So first of all, Paul, let's just address the elephant in the room.
Right.
Can you tell us a bit more about the takeover offer?
Yeah, MindBio, they're a client of ours, right? And they're establishing themselves in the psychedelic market, and they're growing to a small multinational company. So look, there's a lot within the facility at IDT that would be very desirable for a company like MindBio, and MindBio have present a desire to buy all the shares of the company. So there is a non-binding offer on the table by MindBio. They have put the initial offer of 15 cents. It hasn't been endorsed by the board right now, but the board, in good faith, are acting out first stage of due diligence. So we are in due diligence discussions and that program. But yeah, look, there's a lot in IDT that would be very desirable for a company that's growing like MindBio.
Okay. And just regarding the rounds of due diligence, is there a set timeline that you can present to investors today regarding potential acceptance or potential rejecting of some of the offers?
I don't have a set timeline right now, but they are very interested, and IDT is very desirable, so they are wanting to move as fast as they can.
Well, thank you very much for the update. Now, moving on to the strategic significance of ADC. Now, so obviously IDT is building the first commercial scale ADC facility. Now, what's the strategic significance for IDT and just generally for the broader pharmaceutical industry?
Yeah, look, antibody drug conjugate today is 13 million. I think there's 11 assets that have reached commercialization. So $13 billion over 11 assets. They're small scale, but very, very high value. So for us, having small scale, high value, high complexity, high potent products coming through our facility, going into off bench into patient, is an extremely high value for us, given I've just read out results of 14 million, and you've got these assets in a commercial setting upwards of $1 billion, right? So it's very significant. Australia, Melbourne is subscribing heavily to mRNA vaccines, but then you start putting in an antibody drug conjugate technology platform, the sovereign manufacturing and general ecosystem within life sciences in Australia will benefit in attracting antibody drug conjugate players into Australia. And they're already doing their clinical trials in Australia, but we're offering the opportunity to have them manufactured and delivered to the clinical sites in Australia.
Okay. Oh, thank you for that clarification. Now, moving on to your revenue forecasting. Obviously, you guys, financial revenue jump of 91% year on year, which is pretty good. Between 12.9 and 13.4 for IDT becoming operating cash flow break even, hopefully by year end.
Yes.
Now, is this growth solely being driven by IDC, or are there other revenue streams which are being, large participants in that growth?
No, it's all driven by, well, we have received a grant offer for non-dilutive funding for the state government, but that's really to accelerate facility build and expansion. So the revenue generated is solely IDT. It's coming from our business development teams, and it's also coming from our client base that we have with their own natural growth. So, for example, a phase 1 trial might be 100 doses, phase 2 trial might be a few thousand, and a phase 3 might be many thousands, right, depending on the indication. And then a commercial, it might be millions. So we've got some clients that have gone all the way through and approaching commercialization. So the volumes are going up tenfold or more.
Yep.
And they're generating greater volume, economy of scale, and more predictability. So not only are we bringing new clients through, we're getting a really good return ratio from our current client base. That's what's driving the growth.
Yeah. Okay. All right. Well, thank you for that one. And just moving on, obviously, it's a pretty saturated marketplace in which you guys are working. And again, it's, when I say saturated, it's, there's many competitors, and obviously it operates on a global scale with these companies testing in plethora of nations. What competitive advantage does IDT really have over the market?
Yeah, I think what we're seeing is we're seeing drug shortages all over the world. We're seeing supply constraints. The trend of the pharmaceutical companies is to release their manufacturing assets and progress to outsourcing to a contract manufacturer. So that is perfect for us. We're well positioned for that. We're in a high quality environment regulated by the TGA. So we're a good destination as a CDMO. Now, a lot of these biotechs, life science companies want to do their first in human trials in Australia. So again, we're positioning ourselves to manufacture those trials and bring them through to the sites. That's a highly desirable place to be. Focusing on the complex formulations, they're even more a premium with a CDMO. So establishing
Yeah.
a bank of complex formulations runs on the board, delivery and execution. The Sanofi deal is quite a big one for us. That's validated, one, our level of execution and the quality that we bring to the table. So a lot of the companies are watching that, and they'll follow through as a result.
Okay. All right. Well, thank you for that one clarification. So just moving on to the share price now. Obviously, you guys have performed really well recently. Do you still believe there's kind of substantial upside to be seen in the next 12 to 18 months? And what sort of key milestones can you have for the market that will probably prompt that growth?
We've got building and land sitting around about 17 million, and we've got a insurance valuation of 88.8 million for plant and equipment. So market cap sitting around the 40 million mark or just shy. We obviously move through into profitability and create that validation for shareholders. You would imagine that the share price is going to follow suit, because I feel with the assets that we have here on site, we're quite undervalued. The market has struggled in recent times for small caps, and I think that we've seen we've reflected in that. But as we move through into profitability, we continue our pipeline and grow more predictability. I think our share price will follow suit from that.
All right. Well, thank you. Now that finishes off my questions. We've got a couple of questions from participants here. So the first one is, good afternoon, Paul. You spoke about the fixed cost structure being significant as it
Yep.
covers circa 10 facilities, and hence there is significant operating leverage for this business as revenues grow from current levels. Could you provide us with a feel of what percentage of the overall facility is currently being utilized? And if it's circa kind of 10, 20%, and the company is running at circa 15, 16 million to break even, presumably another doubling of revenue would still mean capacity utilization of below 50%.
Yeah, there's a lot in that one. But
Yeah.
so I guess the fixed costs, obviously talking about our insurance and our power, and the indirect staff, right? So we're keeping those as flat as we can. We are about to put 300 kilowatts of solar on the roof. So again, we should be able to bring down our power costs and reduce that fixed cost. So then when you spread that over a facility that's was 5% utilization, now we're sitting around the 40% utilization. That's on a single shift 5-day operating model. You can see now that we're starting to blend that fixed cost over a greater proportion of manufacturing, brings up the margins of each individual product. With the growth and the pipeline coming through, we on a single shift 5-day operation, we expect to get up closer to 60-65% facility utilization, and that generates a proportional amount of revenue. So you could consider it linear, but with the mix that we're trying to bring in being more low volume, high value, we think that the mix will break beyond a linear projection. So we should be able to increase that quite substantially.
Okay.
And, you know, if we can break into the 20 plus million over the next financial year or the other year, we'll well and truly be on our way to sustainable profit.
All right, well, thank you. Now, just moving on to the next one. Regarding the existing facility commented sufficient to support 805 SOM running full capacity with future capacity enhancements, is the CapEx work of 3.8 million budget as part of the capital raising part of the capital enhancement component? And does the future facility capacity funded by the VITGov grant add it to the 805, or is it already built in?
It's built in. It's built in, and yes, the 3.8 is built into the facility capital raising.
Okay. Just to pivot with another question now. Have you considered doing a sale and long-term lease back on your property assets to try and unlock further shareholder value to avoid further dilutive on-market capital raises?
Yeah, absolutely. Great question. We do consider options such as that. I think it's also quite attractive and quite a significant benefit to own all our buildings and land. So no, we have considered it. We've generally decided that no, it's better to keep the ownership of the building and land right now.
Okay. All right, well, thank you for that. Now, moving on. Has the medical cannabis segment stabilized after some slowdown in the first half of the year? And how much of the group revenue is from the psychedelic medication after TGA permitted prescription of MDMA for the treatment of post-traumatic stress disorder?
Yeah, very good question again. So I would say during FY23, a large proportion of our 7 million in sales was based on cannabis. And we did hit a headwind. There's a lot of flooding of the market. So the return business of our medicinal cannabis didn't hit what we were projecting because the market was flooded and our clients didn't have the sales that we were expecting. So we have seen a return. I'm pleased to say that the last 2 quarters, we've seen an uplift in medicinal cannabis sales, and some of our clients are doing quite well. But again, we've built reliance now on other platforms. So our API business is growing quite rapidly. So it's offsetting any losses in medicinal cannabis. Our oral dose in a tablet form is really had some uplift, and it's running at capacity right now in oral tablet making, and then also our advanced therapies just starting to take off. So when you see that 3-colored chart, you'll see the light blue starting to increase in further quarters. So yes, medicinal cannabis is making a comeback, and we've also built less reliance on those forecasts. So the TGA, as our viewer explained, has opened up for the psychiatry field for authorised prescribers to treat mental health patients with MDMA and psilocybin if they've failed the traditional formats for for post-traumatic stress disorder, for example. So we are seeing quite a large demand for psychedelic. The company that has put the MBO in MindBio are very heavy in the psychedelic space. So we're seeing substantial growth in the psychedelic as well. And again, that's part of the offset to their initial fallback from medicinal cannabis. But medicinal cannabis coming back, and psychedelics also pushing into that API, driving API sales, because we're synthesizing the molecules, and then we're also putting those into tablets and capsules.
Now, how do you view the competitive environment as customers grow to larger volumes and the cost differences between yourself and manufacturers offshore?
Yeah, we got room to grow. So as I said, we have a 4,000 litre reactor here, so we do have plenty of headroom to scale up. And as you scale up and the product approaches commercialization, you obviously one, you need to offer the scale economy back to your client, but also you also can attract greater margin yourself. So that's a good place to be in, and we have room to grow. With the competitive landscape, we're the only facility in Australia that offer clinical phase and commercial phase API synthesis, finished dose manufacturing, plus the R&D that goes into that, and also the labeling, packaging, all under one site. So as far as competitors go for an end-to-end solution, we're pretty much on our own. There are individual CDMOs that do those pieces, but when a client's got a substantial IP and a new idea, they prefer to have it all at one site so that there's less opportunities for IP leak. So having a CDMO that's going to take it from end to end and do most of the work for them is highly desirable. So we don't have a lot of competitors in that space locally.
Yeah.
We do have some global competitors, but what's attracting them to us is the fact that we're manufacturing in Australia, 43 cents back in a dollar for R&D work is a potential, and then also putting into a very fast-paced phase 1 clinical trial approval process. So there's a lot of drawing factors there for us, and that doesn't give us a lot of competition as a result.
Okay. Well, thank you for that clarification. And just to wrap us up for the day, has IDT had any discussions with the government to help with the pharmaceutical shortages, as well as on such, potentials for contracts on that basis to fill those supply gaps?
Yeah, look, we've had multiple conversations with the government. We've even had conversations with the White House on drug shortages, we are playing a very small role in drug shortage priority medicines that we manufacture to alleviate those drug shortages. But the stumbling block that we've had to date is the pharmaceutical companies that have the licenses, that have the deals in place with the government. They need to bring us in as a preferred supplier, and probably the process to do that. Like the business development 6 months and R&D 6 months, it takes quite a while to get that registration with a new supplier. So we're competing against time, more or less, but we are playing a very small part in the drug shortages. We stand by to play a much bigger part, and maybe that is an area where the government could step in. The government could step in and say, all right, well, we're going to sponsor the R&D or the process tech transfer or the development part of that, the CMC build, so that you can put your dossier in and get another supplier onto your supply plan. Perhaps that's an area where the government could sponsor and produce more suppliers through to those companies that are having constant drug supply shortages. There's a play there for sure, which I think would benefit all the consumers as a result.
Well, thank you for that clarification. Well, that wraps everything up for us today, Paul. So thank you very much, ladies and gentlemen, for attending. And thank you again, Paul, for your time. Really appreciate it.
My pleasure, Ryan. Thanks for having me today.
You.